Welcome to The Explainer. Today, we're diving headfirst into a really fascinating financial mystery. So if you've been keeping an eye on the markets lately, you probably saw Alphabet's July 2026 earnings report and, the totally bizarre reaction that followed it. We're going to open up the hood, look right past all those flashy headlines, and figure out exactly what is actually going on with one of the most powerful companies on the planet. Let's get into it. So let's start with the big headline, the one that literally had everyone's jaw on the floor. Alphabet reported an earnings per share, their EPS, of $9.11. To put that into perspective for you, the general consensus from financial analysts, they were expecting roughly $2.89. I mean, that is just a historic beat. We're talking about a reported number that is almost 4 times higher than what Wall Street was expecting. And normally, right, when a company crushes expectations like this, you totally expect the market to throw a massive parade. But here is the paradox. The very next day after these stellar earnings were announced, Alphabet's stock didn't soar. It actually plummeted. It dropped more than 7% almost immediately. That wipes out billions in market value and left a lot of retail investors completely scratching their heads. You really have to ask yourself, how on earth does a company quadruple its expected earnings and then immediately get punished by the market? Okay, so what really happened here? Now, you might have seen some of the news stories trying to explain away this drop. Some folks pointed to this hefty €890 million fine from the European Union. Others were pointing at some comments Donald Trump made regarding potential new tariffs. But let me tell you, those are complete red herrings. They have very little to do with a 7% structural drop in a trillion-dollar tech giant. To find the actual story, we've got to ignore the noise, skip the superficial headlines, and dig straight into the SEC filings. Because when we strip away the illusions hidden deep in the footnotes of those official documents, a completely different picture emerges. Yes, the reported EPS was $9.11. But when you adjust for artificial one-time gains, their true operational EPS was actually just $2.85. Compare that back to the analyst consensus of $2.89, and suddenly, wow, this wasn't a historic beat at all. It was actually a slight miss. So the market wasn't acting irrationally by dropping the stock 7%. It was acting exactly like a rational investor who took the time to read the fine print. So where exactly did that massive discrepancy come from? Well, the answer is $98 billion in what the accounting world calls unrealized gains. Basically, in this quarter, Alphabet recorded a massive paper valuation increase on their equity investments, primarily their stake in SpaceX and potentially Anthropic too. But here is the catch, and it's a big one. The word unrealized means absolutely $0 actually entered Alphabet's bank account. None. It's just a theoretical revaluation of the assets they hold in their portfolio, and honestly, they're restricted from selling them in the short term anyway. That massive EPS spike, it was just a paper illusion. But hey, despite that little EPS illusion, Alphabet's underlying business is still an absolute powerhouse. Just looking at the raw numbers, their total revenue hit $119.8 billion. That marks a fantastic 24% growth year over year. Operating income went up by 30%, and Google Search, the old reliable engine, brought in $63.3 billion. But I want you to look at the bottom line here. Google Cloud brought in $24.8 billion. That $24.8 billion figure for Google Cloud, that represents an insanely impressive 82% year-over-year growth. I mean, this is the true growth engine of the company right now. And what's honestly even more impressive is the momentum. Think about it. In the first quarter, Cloud grew by 63%. Now it's at 82%. It isn't just growing, it is accelerating rapidly. And the operating margins for the Cloud division, they more than tripled. And guys, the future for Google Cloud looks even more remarkable. If you look really closely at page 48 of their 10Q filing, you'll see all these details on their order backlog. They have so many signed contracts lined up that an estimated $250 billion in cloud revenue is expected to be recognized over just the next 24 months. Think about that for a second. A segment that generated roughly $77 billion over the last 12 months is effectively scaling up to double its size. This totally transforms their infrastructure spending from like a speculative bet into a solid investment against demand that is already locked in with signed contracts. Now, speaking of infrastructure, we absolutely have to talk about AI. Because for a while, there was this big fear in the market that artificial intelligence would cannibalize Google Search. But the hard data completely debunks that myth. Search still grew 17%. Meanwhile, their Gemini app has skyrocketed to 950 million monthly active users. Alphabet is now processing a mind-bending 22 billion AI tokens every single minute. I mean, that's up from 16 billion just a quarter ago. And for the advertisers, these AI-driven ad campaigns are yielding 15% more conversions. So right now, AI is definitely not cannibalizing search, it's driving major expansion and user engagement. But here is the plot twist of our story. To fuel all of this insane AI and cloud growth, you need servers. You need massive data centers. And that brings us to an absolutely eye-watering bill, $44.9 billion in capital expenditures, or CAPEX, for this quarter alone. That is literally double what they spent in the same quarter last year. It is the heaviest, most aggressive investment cycle in Alphabet's entire corporate history, and management has already signaled that the spending is going to increase even further into 2027. So you might be wondering, how does this heavy spending actually impact their cash on hand? Let's just walk through the math together. Alphabet generated a really healthy $39 billion in operating cash flow. But when you subtract that historic $44.9 billion in capital expenditures just to build out these data centers, you get a final number of negative $5.9 billion in free cash flow. I really want to pause here and just underscore the gravity of this moment. A negative free cash flow of nearly $6 billion is a historic first. I mean, since the day Alphabet went public, they have essentially functioned as this unstoppable machine with high margins, low physical assets, just constantly piling up cash. For the first time ever, the cost of building the future has completely eclipsed the cash they're bringing in today. It represents a major structural transformation in exactly what kind of company Alphabet currently is. And you can clearly see this shift in priorities. Just last quarter, the old Alphabet spent $28.3 billion on stock buybacks, rewarding shareholders with their excess cash. But the new Alphabet, they completely suspended stock buybacks this quarter. $0, nothing. Instead, they are issuing debt and preferred shares just to finance the construction of more data centers. It's a completely different capital allocation strategy than what investors have grown used to over the last 2 decades. Okay, so let's see how this builds into 2 totally different ways investors are looking at the situation, starting with the optimist hypothesis. If you are an optimist, Alphabet's aggressive spending is completely justified. They have a total order backlog of $514 billion, which provides a massive guaranteed runway. Their cloud margins are expanding beautifully to 35.6%. And they have an absolute fortress of a balance sheet with $242.5 billion in cash in short-term assets against only $98 billion in long-term debt. They can easily afford years of negative free cash flow to aggressively capture this AI demand without even breaking a sweat. But as any good detective knows, you have to look at all the angles. So here is the prudent investor's hypothesis. This level of spending carries deep structural risks. Spending upwards of $200 billion a year on CAPEX, that creates substantial future depreciation that is going to weigh heavily on their income statements for years to come. Sure, they have a signed backlog, but contracts can be delayed or renegotiated or even canceled. Plus, they are facing fierce pricing wars from Amazon and Microsoft. And perhaps most dangerously, AI chips are evolving so incredibly fast that the ultra-expensive infrastructure Alphabet is building could become obsolete much faster than their financial models suggest. Which brings us to the core takeaway of this entire explainer. The quality of a company and the quality of an investment at a given price are always 2 different things. Alphabet is undeniably a phenomenal company. They have incredible revenue growth and visionary technology. But when a company undergoes a radical, capital-intensive structural shift like this, the return on that invested capital is no longer a sure thing. The market wasn't punishing Alphabet because it's a bad business. It was repricing the stock because the cost of future growth just got astronomically more expensive and way more uncertain. So I leave you with this final big question. Which hypothesis is actually going to play out? Will the optimist be proven right as Alphabet's cloud backlog converts into this massive tidal wave of revenue? Or will the prudent investors be validated as depreciation and competition start eating into those returns? Honestly, the only way to know for sure is to keep opening up those official documents, ignoring the daily noise, and tracking the real numbers. When the next quarter's data drops, well, now you know exactly what metrics to look for. Keep asking questions, keep looking under the hood, and I will see you on the next explainer.